Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute for December 1st, 2013. Markets were up for an 8th week in a row last week, bringing them to a state of being technically overbought over most time horizons. But an important distinction this fall has been that when stock prices have gotten to this state before, instead of retreating, they have resolved that status with a sideways move. Well, that's the sign of a bubble market, and we are certainly in bubble conditions. However, whether or not we end up calling this current period a bubble later on depends on what happens going forward. Prices have been inflating in a bubble-like way, but the rally is probably only about halfway to the bubble stage being fully inflated. It's not yet certain we'll get there. Current momentum certainly suggests that we can get there, but it's only a suggestion. What happens in December, and indeed for the months to come, depends on the Federal Reserve. The stock market has come to almost universally accept that the current rate of quantitative easing is the buy or sell decision factor. Whether or not that's justified on the fundamentals has stopped mattering in favor of the obvious price action. The feeling is that so long as everyone else seems to believe it, why fight it? As for this week, I suspect another sideways move. The two keys to this month are most likely going to be the jobs report this Friday and the Fed meeting in 2 weeks' time. The days of the employment report are almost obligatory rally days, but you might see some mild selling before then as people trim positions in advance of the report. If the report is strong, which is to say more than 200,000 new jobs on the headline number, it could very well introduce some worries about an early taper by the Fed. If it's in Goldilocks territory, which I estimate to be anywhere between 140 and 195,000, expect a rally. And we can talk more about the Fed meeting in a couple of weeks. One factor worth noting now is the amount of money that's been pouring into equity mutual funds. There hasn't been anything like it since the tech bubble. Now, some of it is being driven by those gaudy price increases, but I suspect a lot of people are also thinking, well, the market is going to keep up so long as the Fed keeps helping out, and it sure doesn't look to me like the economy is really getting better. So the Fed should stay in, and I might as well jump in too. Be careful, because everyone jumping in means that they were in the last inning. However, the last inning usually lasts months longer than most people think it will. So those who were ready to jump out at the beginning get comfortable as more people jump in. And then everyone gets so comfortable that when the bubble does start to deflate, people don't believe it can happen anymore. And they keep buying the dips because they don't want to miss the next move up. Well, I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.